Hi there, and welcome back to the Long Bond View, Rubrix Asset Management's fixed income macro discussion. My name is James Galvin, and as always, I will be joined by my colleagues Steve O'Hanlon and Killian Fitzgerald to discuss all things fixed income. Thanks for listening. Now, gents, this week I think we can probably wrap it up fairly quickly because not a huge amount has been going on in the global bond market, I think it's fair to say. Or is that okay? That's a cheap gag. Look, it's obviously been a pretty tumultuous couple of weeks. Steve, there's definitely a narrative that has grown and is pretty pervasive. Higher for longer. Bear steepening across global yield curves. What do you make of it all, and what do you think is really sort of driving this price action?
Well, look, as you said, James, significant price action, and certainly in my career, which has now gone on a couple of decades, to say the least, it's been the most difficult couple of months to figure out what was going on. And partly because some of the data that we were looking at certainly confirmed our view that the economy was slowing down and the inflation outbreak was becoming more and more under control, if not with that little oil shock of the Saudis and Russians' decision to extend their cuts. But I think really what we saw in August was a concern from the central banks, and we then saw that in Jackson Hole about this kind of reemergence, this reacceleration story that they felt was happening. And there was a kind of a shift of a view from the inflation outlook to the growth outlook. And from that perspective, the kind of people put behind the fact that we saw a PCE month on month of 0.1, and we're really looking at these growth numbers and saying, oh, look, this is going to reaccelerate. People were showing the graph of the 1970s, showing this inflation spikes coming back, even without the pivot from the Fed, which is what happened in the 70s. So I think a lot of things came to a head. And then once the market started selling off on that, I think it got a bit of a life of its own. And then, of course, this just reinforced the selling. But certainly, I think there was a shift from the Fed in thinking we have not done enough to knock out this potential inflation story, and we need to accelerate that. And I think it was a lack of patience on the side of the Fed, where they kind of went, look, do you know what? Not enough has happened. The slowdown in inflation is coming, and it's still nowhere near our targets, even though it's come down a lot, and we need to do more. Now, part of that is to do with what happened during the year. I mean, this year was not just all about rate hikes. There was what happened in January, and we've talked about this quite a lot. In January, we saw a huge stimulus package come from Japan when they were backing their YCC program. We saw a massive stimulus program from the US in March to back its banking system. And then, ironically, the debt ceiling argument, where they drew down about $1 trillion out of the global treasury account. Again, that acted as a stimulus package into the system, which more liquidity coming in, and that helped keep driving things higher for longer. And not to mention, of course, the fiscal situation in the US, where we're running pretty large fiscal deficits. So it was taking a while for the rates to kind of feed in. And I think really in August, I think everyone just kind of gave up and said not enough has happened, and we're really going to reprice the rates outlook. Now, in hindsight, that might be seen as a mistake because we definitely seeing those things happening, and Killian will talk about that. But from my perspective, it is a bit surprising given where we are in the economy right now, and the noise is there around the bond market and a very strong economy. But the data doesn't back that up to the same extent as what I think the bond market is saying it does. But certainly that impact has certainly been felt across the board for sure.
So just on that point of data, Killian, what are we seeing? Are we seeing a rolling over of things, or a reacceleration, or what exactly is the story?
Yeah, look, I think as Steve mentioned, the narrative that there was a reacceleration in economic growth kind of took hold over the summer, and we never really bought into it. And I'd have to say the data, for the most part, I mean, parts of it certainly support some underlying strength in the economy, but for the most part, we'd say that the data is actually moving away from that and moving to a place where inflation is coming under control, where the consumer, while still resilient, is losing a bit of momentum maybe. So if you look at it, inflation, first of all, I mean, to look at the sort of short-term dynamics in inflation, we look at the 3-month inflation numbers. So the annualized rates of 3-month inflation, if you look at core CPI or core PCE, whichever one you pick in the US, both of those are sitting just above 2%. So they're almost back at the Fed's target. Now, where you're seeing a little bit more pressure in inflation is in the headline numbers, where obviously the recent rise in the oil price has fed through into kind of the headline numbers. But in theory, the central banks shouldn't really react to the headline numbers, because those volatile food and energy components are deemed to be not within their control. And the kind of core inflation measures, which are more within their control, are definitely converging back towards inflation targets. So in that respect, inflation is actually in a better place now than it has been in quite some time, in several years. If you use that 3-month annualized measure, we're at the best place we've been since before this inflation spike really picked up in sort of 2021. Another thing to look at on the inflation side is the diffusion of inflation. So by this we mean, of the various components of inflation, how many are seeing prices going up versus how many are seeing prices going down or static. And that diffusion is at a roughly 60-40 ratio at the moment, I believe. So 60% of the components are seeing rising prices, 40% are seeing either static or declining prices. Now, in an extremely inflationary environment, like, for example, the 1970s, those diffusion numbers are up near 100%, where virtually everything is going up in price. And that's not what we're seeing now. That's never really been what we've been seeing in this kind of bout of inflation. So when the Fed was talking about transitory inflation, this was one of the metrics they were looking at and going, actually, this inflation is very different from the 1970s, because it's not everything. Not everything is going up in price. It's all right, there's 60% of the components are going up in price, but not anywhere near 100%. And from that point of view, the inflation is broad-based, but it's not all-encompassing. So it's a very different dynamic from other bouts of inflation in, say, the 1970s. Other things that have been touted as a driver of this kind of reacceleration was obviously the strength of the US consumer. And in the initial readings of Q2 GDP in the US, consumer spending was, or personal consumption as it's called, what was a huge component of the growth in GDP. But as second quarter GDP has been revised downwards in its second and final readings, the strength of the consumer has been revised downwards in both of those cases, both of those revisions, and is now nowhere near as strong as it was on the first reading. And this is kind of an indication that actually the resilient US consumer isn't quite as resilient as had been thought. And if you look at other measures, I guess, such as consumer confidence in various surveys is turning down, credit card debt is rising, excess savings that were built up over COVID are declining, and there's certainly, when you look at the whole economy, obviously you're looking at an aggregate measure, but within that, obviously the wealthier cohorts have retained greater amounts of savings than the not so wealthy cohorts. So there are people there certainly who are running out of that kind of buffer that had been built up over COVID. Another metric that we were looking at was retail sales. So retail sales had grown, but retail sales is a nominal metric, and if you factor in inflation and look at retail sales by volume rather than by dollar value, they actually haven't really grown and haven't shown any significant strength there for a while. Bankruptcies are ticking up on stuff like credit cards and auto loans, so that's another metric that the consumer is starting to come under pressure in the US. So overall, like to sum up, I guess the data is not terribly weak per se, but there are definitely metrics there that are turning the corner and wouldn't really support that narrative that the economy is reaccelerating now.
It's quite interesting because you're talking about sort of annualized 3-month inflation being not far off Fed target, and against that we're now at 5% yields really across the Treasury curve, give or take. So we're talking about at least 200 basis points kind of positive real rates, if not higher. I mean, Steve, from that perspective, we've got to be getting close to a point where something gives up.
Yeah, I mean, this is what makes kind of government bond investing kind of unique to most other asset classes, because one thing that happens as government bonds sell off and yields get higher, prices get lower, they kind of have these mechanisms, these self-fulfilling mechanisms, which kind of slow down the environment, which supports their own prices. So what we've seen over the last week or so was really a follow, as bond yields went up pretty aggressively. We've seen this follow through into other asset classes, like, for example, the US dollar, and putting pressure on other central banks. So we've had intervention, or certainly verbal intervention, by a number of central banks in the last few days in protecting their currencies. Most global bond markets are also selling off. And if you certainly looked at the data in Europe, for example, over the last couple of months, certainly it's not something to get excited about, and certainly not something you'd expect to see such a large sell-off in the bond market on the back of such weak economic data. So this kind of sell-off now is really starting to affect other asset classes. And we've seen a little bit of kind of nervousness now in risk assets as well, where equity markets are starting to wake up to this higher yield and the potential trouble. And in fact, it's also put a bit of a slowdown on the oil price, because there's been a lot of talk about $100 a barrel of oil of WTI, and that there's a massive excess demand over supply right now. Well, we peaked out at 95, but as rates continue to rise, we've got down to around 87.5. And it doesn't mean, by the way, that this rally in oil on these cuts won't have another leg higher. But certainly we're seeing how the higher rates are already starting to feed into other markets. And we saw two examples over the last year or so where these kind of spikes become quite dangerous. In the UK, for example, after Liz Truss, very dangerous budget, and we had a spike in gilts, their whole basically pension fund industry nearly fell over. We had a situation in March when rates spiked to about 440 on the 10-year. We saw the problems with the regional banks in the US and SVB and these type of things. So, these very aggressive spiking in yields do have knock-on impacts, and we're already starting to see steam start to build in the global markets, and that gives you an indication that rates are getting to a point now where they're causing potential damage. And this is the worry. I mean, historically, it could be argued with most cases that the Fed has over-tightened going into these situations. And when we look at the dynamics of the US economy, and the last time we had rates of 5.5%, its national debt was about $3 trillion, which is about 50% of GDP. Today, debt levels are $33 trillion, which is about just over 120% debt to GDP. And you look at other countries in the similar circumstances, the level of leverage in the system now, it's a combination, of course, between corporate, household, and government debt. It seems difficult that we're going to be able to sustain these levels for very long. Now, the fact that we've termed out a lot of this debt, out the curve, as it were, and longer maturities. And in Europe, it's very different. Households have shorter fixed mortgages. In the US, it's 30-year. But still, the marginal change of someone's ability to buy a new house and to fund it at current valuations means that most houses are unaffordable now. So it's telling you rates are at a very, very difficult point in terms of long-term growth. And of course, we're seeing that in the commercial real estate space now, which is really starting to suffer. So we know that these higher rates are starting to filter in. And that's where we kind of see that the slowdown in the sell-off happen, that eventually rates get to the point where they start damaging things. And we just had announcements from JP Morgan and Goldman's last night on that sell-off after that weird JOLTS number. That certainly wasn't confirmed from the ADP numbers today, that that sell-off in rates is starting to worry people because it's been so aggressive and so much. So I suppose from our perspective, there's a self-leveling mechanism within government bonds, and it's certainly our view, given the state of the global economy, and to add China into that equation as well, that rates are at the point now where they're not sustainable at these levels very long. And the impact it's having on other global markets now tells you that this can't be sustained indefinitely at these levels.
Yeah, and just lastly then, I mean, just a quick word maybe on sort of how we're looking to sort of play this from a portfolio perspective.
Yeah, I mean, from our perspective, I mean, we obviously had a very difficult year. Government bonds were very badly damaged last year as well, and it's kind of reoccurring this year, certainly to this point. But from our perspective, the downside risks have been for quite a while from the beginning of the summer, where risk assets are kind of priced to perfection, where they're priced for this reacceleration, they're priced for no recession now, they're priced for, you know, if there is a recession, it's not really going to feel like a recession type scenario. So from our perspective, you know, while at the moment it doesn't seem like the right call, we still are very nervous about the potential for a recession, which obviously has heightened a lot in the last couple of weeks because of the raise in rates and the Fed's, you know, consideration that, look, even if we get into a recessionary type environment, we're going to keep rates higher for longer. That can bode well for risk assets. So from our perspective, credit spreads, you know, and things like that are still trading at extremely tight levels. And actually, if you look at the breakdown of the dynamics of the credit markets and the default rates, etc., there's no correlation at the moment, which is very unusual. And Killian has obviously been pointing this out to us for a while now, between where credit spreads are vis-a-vis the underlying strength of the credit markets themselves and the credit dynamics in the economy. So there is a very big disconnect there right now, partly driven by the excess liquidity coming out of the back of COVID. So these things still need to get readdressed. And I'm certainly a lot happier at these kind of return levels. While painful when they happen, they do increase the overall return in the portfolios. And there is, you know, that mechanism where actually they become even more attractive the higher these rates go. But we do think at this stage, the economy is now starting, and the global economy with the strong dollar is taking a bit of a hit on this sell-off, which I think the Fed's lack of patience and the market's lack of patience, why hasn't the recession happened, you know, might have been about 6 months too early. And if they just waited a bit longer, I think they would have seen that. And we're seeing that again today with some of the jobs numbers we saw today. Kind of indicates, guys, you know, you panicked too soon, and the data was coming, and, you know, this potentially means a slightly harder fall now than it would have been if rates had been more normalized in terms of their movement. So yeah, very, very difficult couple of months in terms of the markets. But I think from a portfolio perspective, it just kind of makes our concerns about the valuations of some risk assets to be that little bit more worrisome.
So in summary, we do still believe the duration paid can pay off, and certainly it's very early to be looking at things like credit with very, very tight spreads this late in the cycle.
Yeah, I mean, certainly from our perspective, we were very underweight duration for probably the last year and a half, and then coming into the summer, as we saw some of the data points start to reflect a slowdown, and we saw some of those dynamics in the bankruptcies and things like that, you know, and certainly the auto loans, etc., credit cards, certainly gave us an indication that the economy was slowing, which traditionally would put a situation in that we have a bull market steepener as opposed to a bear market steepener. You know, obviously concerns over the summer, put that to one side. But yeah, from our perspective, you know, the data that we're seeing, you know, people might get excited about an ISM that comes in at 49. That's still contraction, 11 months in a row of contraction. Like, you know, of course it's going to mean revert back to 50, because you had no orders last month and you have no orders this month. Well, then it's 50, right? So yes, the manufacturing, but what we're seeing now is a follow through to the ISMs, which are starting to in services, starting to go down. So yes, we do believe, James, that, you know, the sell-off in duration, as painful it was, actually sets up the markets, you know, even stronger for that trade, because the knock-on impact is going to be so severe.
Yeah. Well, that's excellent stuff, guys. Thank you for your time, and we shall speak again in the near future. And thanks everyone for listening. All right, take care.
Thank you.
Thank you.